Welcome to SecedNow.com. Our goal is to explain what is going on in the United States in easy to understand videos. This video explains how the banks create money through the use of reserve banking.
Father, Brian and I wanted to talk to you again about the Federal Reserve. In our previous discussion, you said that the Fed had the ability to create money.
How is it that a private corporation, that cannot be audited by Congress, has the ability to create money? That sounds like a scam.
In order to explain this, you will have to understand how the banking system began. Thousands of years ago, before real banks existed, people had no place to store their money. However, goldsmiths generally had some sort of secure safe. They came up with the idea that they could charge people to store their money. The people would bring their money to the goldsmith, and for a small fee, they could store that money in the goldsmith's vault. The goldsmith would give them a receipt for the amount of money they had deposited. The people soon learned that they could trade these receipts to other people for goods. This, in effect, became the first paper money. Unlike today's money, however, it was backed 100% by gold. They knew that at any time, they could redeem the receipt for gold.
How does this relate to our current banking system?
I'm getting to that. After some time, these goldsmiths realized that, at any one time, only about 10% of the people wanted to withdraw their actual gold. So, the goldsmiths began issuing more paper receipts than they had gold in their banks.
So, Father, what would the goldsmiths do with those extra receipts?
They used them to purchase products from other people. In effect, they printed fake money and made a huge profit from these counterfeited bills. At the same time, they increased the money supply by the amount of counterfeited bills. With more money in circulation, people felt richer. However, the only person who was really richer was the goldsmith.
So, how much of this fake money could the goldsmiths print?
That depends on how many people were actually withdrawing their gold at any one time. If only 10% of the people ever wanted their gold back at the same time, then the goldsmiths could print $9 of fake money for every $1 of gold. In theory, if someone deposited $1,000 worth of gold, the goldsmith could counterfeit an additional $9,000. In reality, this would all be profit to the goldsmith.
But, that means that there is only $1 of gold in the vault for every $10 worth of receipts. So what happens when people present more of these phony receipts than there is gold in the vault?
Therein lies the crux of the problem. When the people realized that the goldsmith had swindled them, he would have been hung from the nearest tree.
But, if I understand you, then 90% of those receipts that the goldsmith printed would have been worthless pieces of paper, and the people holding them would have lost all of their money.
That's correct. Now, fast forward to the United States in the 1800s. Individual banks operated pretty much the same way as the goldsmiths. Let's say that someone came into the bank and deposited $10,000 in gold. The bank would then give the customer a receipt for $10,000. These receipts were called banknotes. Now that the bank had $10,000 of gold in their bank, the bank then felt free to loan $9,000 of the gold to other customers. So the customer who borrowed the $9,000 would use it to purchase cattle, or lumber, or equipment from a local business. Then that business would redeposit the $9,000 in the bank. The bank would then give him a receipt, or note, for his $9,000.
Let me see if I understand this. The bank still has the $10,000 in gold, but it has issued $19,000 in banknotes. Is that correct?
Yes, and now the bank feels free to loan 90% of the $9,000 that was just deposited. So it loans $8,100 to a third party. That person uses it to buy merchandise. Then that merchant deposits the $8,100 back into the bank, and receives a banknote for $8,100.
Holy cow. Now the bank has issued $27,100 in banknotes and only has $10,000 in gold. How long can the bank continue to do that?
Mathematically, the bank could loan out a total of $90,000 from the original $10,000 of gold that was deposited. In other words, the bank has promised to repay customers $100,000 in gold when they only have $10,000 in gold in the vault. But, the bank has created $90,000 of new money. When this happens, everyone feels much richer. The conservative banks would retain larger reserves of gold, and thus there was less chance of there being a run on the bank. The downside to that is that the banks would loan less, and, therefore, they would be less profitable. However, they would be more stable and less likely to go bankrupt.
But the more aggressive banks would loan out as much as possible and keep very little in gold reserves. Then they would be more susceptible to a run on the bank.
Now you are beginning to understand.
Getting back to the banknotes and the gold reserves, something doesn't seem right here. It looks to me like their books should be out of balance, big time. You said that the bank had issued $100,000 in banknotes but only had $10,000 in gold reserves. What happened to the other $90,000?
What you are forgetting is that the bank would also have $90,000 worth of receivables from where they had loaned money to their customers. This was a big improvement over the original Goldsmith banks because those goldsmiths just spent the money. Our bankers loaned out the money and thus had a receivable. Of course, in the real world, not everyone spent their money in the local community. If a rancher borrowed $5,000 in gold and spent it in another town, then that gold was removed from the local bank which drained their gold reserves. Hopefully, people from other towns would then do business in the local town, and the local business would redeposit the gold back into the local bank. That's why trade was so important to all the communities. The problem is that if a lot of the holders of the banknotes want to redeem them for gold, the bank's only recourse would be to try to collect these receivables. That oftentimes resulted in foreclosures on businesses and farms. But, if the bank couldn't get enough gold to redeem the gold receipts, then the banks would go bankrupt. If this happened, then the banknotes held by the bank customers would be worthless. If word spread that this bank couldn't redeem its notes, it would cause a panic at other banks. If there was a rush on a lot of banks at the same time, it would result in a recession. That's why these recessions were often referred to as panics.
But the banks still had assets. They had receivables from their customers that had value. Why couldn't they just borrow some money from another bank, and pledge their receivables as collateral?
Because the other banks didn't have much gold either. If they loaned their gold to the bank that was in trouble, then they might have had a rush on their bank as well. Enter the Federal Reserve. The founders of the Fed convinced Congress that, if they would charter the Federal Reserve, that they could loan money to troubled banks, and eliminate bank panics. What Congress failed to realize was that the Fed was really just another central bank like they had in Europe.
From our previous discussion, it appears that the Fed did little to solve this problem.
That's true. However, as a lender of last resort, the Fed was able to loan money to smaller banks when there was a run on the bank. This had helped somewhat. The Fed was also able to establish uniform standards for bank reserves. This was generally set at 10%, which reduced the number of speculative banks. This was an improvement. But, the unintended consequences were that the banks were now able to take more risks because they knew that the Fed would bail them out. This resulted in larger failures. As we discussed before, the bank failures just kept getting larger and larger as the banks assumed more and more risk. On top of this, after the Fed convinced Congress that it should bail out banks who had made bad loans to businesses and to foreign countries, it created a casino atmosphere of the banks. They were free to gamble with customers' money, knowing that the Fed would always bail them out. Now, we need to pass a law that would revoke the Fed's charter. We need to return free competition to the market. Banks would still be required to maintain minimum reserves, which would be determined by Congress. The public would be protected from risky banks by requiring the banks to post critical information about the bank's health. This would include, but not be limited to, the reserve ratio, non-performing loans, substandard loans, loan loss reserves, etc. And, this data would be audited by certified public accountants.
The problem is that Congress is afraid of the Fed. Such a law, revoking the Fed's charter, will never happen.
This is just another valid argument why the conservative states need to secede from the Union. We need to act now before it's too late.
I hope you enjoyed this video. Please visit our website on secession. It covers the right to secede, reasons for secession, and what the new country will look like. Please tell all of your friends. We need to act now before the United States implodes. Please stay tuned for our next video on how the Fed causes inflation. Thank you.